Some investments appear less risky simply because no one prices them every day. That calm return chart may hide leverage, stale valuations, locked up capital, and losses you cannot immediately see or escape. This lecture goes beneath the glamour of hedge funds, private equity, real assets, and other alternatives to ask the only question that matters: what role do they truly play in a portfolio? When most people first learn portfolio management, they begin with the familiar building blocks: public stocks, public bonds, and cash. These are important because they are liquid, widely followed, regularly priced, and relatively transparent. Alternative investments expand the opportunity set beyond that traditional core. But here is the key idea I want you to remember from the beginning. Alternatives aren't automatically better, and they aren't automatically worse. They are different. They may offer new sources of return, diversification, inflation sensitivity, access to private opportunities, or specialized manager skill. At the same time, they may bring complexity, higher fees, limited transparency, valuation uncertainty, and liquidity restrictions. So the central question is not, are alternative investments good or bad? The better question is, what role does this investment play in the portfolio? Does it improve diversification? Does it provide exposure we cannot easily obtain elsewhere? Are the risks acceptable? Are the fees justified? Can the investor tolerate the liquidity terms? In this lecture, we will study hedge funds, private equity, venture capital, real estate, REITs, commodities, infrastructure, liquid alternatives, illiquid alternatives, diversification, fees, valuation, and due diligence. By the end, you should be able to look beyond the label alternative and evaluate the investment like a thoughtful portfolio manager. Let's begin with the basic definition. An alternative investment is usually defined by what it is not. It isn't a traditional long-only investment in public equities, investment-grade bonds, or cash. But that definition is only a starting point. An investment may be considered alternative because of the asset being purchased. For example, private companies, real estate, commodities, infrastructure, timberland, farmland, or collectibles may all fall outside the traditional public stock and bond universe. It may also be alternative because of the strategy. A manager may use short selling, leverage, derivatives, relative value trades, event-driven strategies, or other approaches that differ from the simple buy and hold public market portfolio. Another reason is market access. Some alternatives give investors access to private transactions or specialized markets that ordinary public securities don't provide. Liquidity is also important. Some alternatives can be bought and sold easily, while others may lock up investor capital for long periods. Valuation can differ as well. Instead of daily exchange prices, some alternatives rely on appraisals, models, comparable transactions, or manager estimates. Legal structure, fees, incentives, and investor eligibility also matter. A useful distinction is between alternative assets and alternative strategies. Private real estate is an alternative asset. A long-short equity fund may trade public stocks, but its strategy is alternative. This distinction matters because alternative isn't one single risk factor. Now let's organize the major types of alternative investments. A practical grouping includes hedge funds, private markets, real assets, and liquid alternatives. Hedge funds are pooled investment vehicles that use flexible trading strategies. They may use short selling, leverage, derivatives, macro views, relative value trades, or event-driven positions. Their purpose may be alpha seeking, downside protection, market neutral exposure, or specialized risk management. Private equity involves investment in companies that aren't publicly traded, or in public companies that are taken private. The goal is often long-term capital appreciation through active ownership, operational improvement, strategic repositioning, and eventual exit. Venture capital is a form of private equity focused on young companies with high growth potential and high uncertainty. Venture capital returns are often highly skewed, meaning a small number of successful investments may drive a large portion of fund performance. Real estate provides exposure to land, buildings, leases, financing structures, and local market conditions. It may offer income, potential appreciation, and inflation sensitivity. REITs provide access to real estate through companies that own, operate, or finance income-producing properties. Commodities provide exposure to raw materials such as energy, metals, and agricultural products. Infrastructure includes essential service assets such as utilities, transportation, energy systems, communication networks, and data centers. These categories are useful, but they aren't perfect. A hedge fund may trade commodities. A private equity fund may invest in infrastructure. A REIT may behave like real estate in normal times, but like public equity during market stress. Always look beneath the label. Let's focus now on hedge funds. A hedge fund is a private pooled investment vehicle that gives the manager flexibility to pursue strategies that may not be available or may be less common in traditional long-only funds. But be careful with the name. The term hedge fund doesn't guarantee that the fund is actually hedged, conservative, or low risk. It describes a structure and a style of management, not a promise of safety. Common hedge fund strategies include long-short equity, where the manager buys securities viewed as attractive and sells short securities viewed as unattractive. Equity market neutral strategies try to reduce broad equity market exposure and focus on relative mispricing. Event-driven strategies invest around mergers, restructurings, bankruptcies, spin-offs, or other corporate events. Global macro strategies take positions based on views about interest rates, currencies, commodities, equity markets, or policy changes. Relative value strategies seek to profit from pricing differences between related securities, often using leverage. Managed future strategies use futures and derivatives across asset classes, sometimes in systematic ways. The appeal of hedge funds is that returns may come from manager skill, security selection, relative pricing, trading strategy, or risk management, rather than only from broad market exposure. But the risks are serious. Hedge funds may involve leverage, short selling losses, derivatives risk, counterparty risk, crowded trades, model risk, liquidity restrictions, operational weaknesses, and high fees. So due diligence must separate true manager skill from hidden exposure to common risk factors. Now let's turn to private equity and venture capital. Private equity refers to investment in companies that aren't publicly traded or in public companies that are taken private. Private equity funds usually raise committed capital from investors, call that capital over time, invest in portfolio companies, work to improve those companies, and eventually exit through a sale, recapitalization, or public offering. Major private equity categories include buyouts, growth equity, distressed or special situations, and secondary investments. Private equity managers try to create value in several ways. They may improve revenue growth, margins, governance, operations, strategy, acquisitions, capital structure, and exit timing. The return depends not only on how the business performs, but also on the valuation at which the business can eventually be sold. Private equity also introduces a cash flow management challenge. Investors commit capital before knowing exactly when it will be called. Later, distributions may arrive only after investments are sold or refinanced. This requires careful liquidity planning. Venture capital is a specialized form of private equity focused on young, high-growth companies. These companies may have limited operating history, uncertain business models, negative current earnings, or products still being developed. In venture capital, many investments may fail or produce modest results, while a few successful companies may create most of the return. That is why deal flow, diversification, follow-on discipline, market size, product market fit, customer adoption, management quality, and competitive advantage are so important. Private markets can be powerful, but they require patience, access, and strong manager selection. Next, let's discuss real estate and REITs. Real estate investments provide exposure to land, buildings, leases, financing structures, and local market conditions. Investors can access real estate through direct ownership, private real estate funds, real estate debt, publicly traded REITs, non-traded REITs, or real estate operating companies. A key idea in income-producing real estate is the capitalization rate, or cap rate. You will see the relationship on screen. Conceptually, the cap rate connects property income to property value. This relationship helps explain why property values are sensitive to both operating performance and market discount rates. If income improves, value may improve. If required yields rise, values may fall, even when operating income is stable. Real estate risks include location risk, tenant and lease risk, interest rate risk, leverage risk, capital expenditure risk, environmental risk, and liquidity risk. Real estate isn't one uniform asset class. Apartments, offices, warehouses, hotels, self-storage facilities, healthcare properties, and data centers can all behave differently because their demand drivers are different. Now, REITs are companies that own, operate, or finance income-producing real estate. Publicly traded REITs make real estate exposure more accessible because they trade on exchanges and can be bought and sold through brokerage accounts. But REITs aren't identical to direct private real estate. Public REIT prices move throughout the trading day and may be affected by equity market sentiment. So the trade-off is accessibility versus market exposure. Public REITs offer liquidity and transparency. Private real estate may offer more direct property exposure, though with less liquidity and more valuation uncertainty. Let's move to commodities and infrastructure. Commodities are raw materials or primary goods, such as energy products, metals, and agricultural products. Investors usually access commodities through futures contracts, commodity funds, exchange-traded products, commodity-linked notes, commodity producer equities, or physical holdings. Commodity investing is different from investing in a productive business. A physical commodity doesn't pay dividends, interest, or rent. Its return is linked to price changes, storage and financing economics, collateral returns in futures-based strategies, and the shape of the futures curve. One important concept is roll yield. Roll yield arises when a futures position is replaced with a later dated contract. Depending on the futures curve, rolling can add to returns or reduce returns. This means a commodity fund's performance may differ from the change in the spot price of the commodity. Commodities may help diversify a portfolio because prices can be driven by supply shocks, inventories, weather, geopolitics, production constraints, and inflation expectations. But they can also be very volatile. Infrastructure investments involve assets that support economic activity and public services. Examples include transportation networks, utilities, energy systems, communications towers, fiber networks, water systems, hospitals, schools, and data centers. Infrastructure may be attractive because some assets provide essential services, long-term contracts, regulated pricing, inflation-linked revenues, high barriers to entry, or relatively predictable cash flows. But these characteristics aren't guaranteed. Infrastructure risks include regulatory risk, political risk, construction risk, demand risk, financing risk, and jurisdiction-specific risk. Again, the label isn't enough. A major distinction in alternative investments is the difference between liquid alternatives and illiquid alternatives. Liquid alternatives are vehicles that provide alternative exposure with relatively easier access and more frequent pricing. Examples include alternative mutual funds, ETFs, publicly traded REITs, listed infrastructure, commodity funds, and some closed-end funds. Illiquid alternatives include private equity funds, venture capital funds, private real estate funds, direct real estate, private infrastructure, and some hedge funds. Liquidity is valuable because it gives the investor flexibility. A liquid investment can help the investor rebalance, raise cash, manage risk, or respond to new information. Illiquidity may be acceptable when the investor is compensated through higher expected return, better access, stronger governance rights, or a better match with long-term liabilities. But illiquidity is costly when cash is needed unexpectedly or when the investor wants to exit during unfavorable conditions. Here is an important point. A liquid vehicle doesn't make a risky strategy safe. It only changes the investor's ability to buy or sell the vehicle. Similarly, an illiquid vehicle doesn't automatically earn an illiquidity premium. Investors earn compensation for bearing illiquidity only if the price, structure, and asset performance justify it. We should also distinguish publicly traded alternatives from private alternatives. Public alternatives offer visible prices, easier trading, smaller position sizes, and operational convenience. Private alternatives may offer access to private transactions, active control, and less daily market noise. But they also bring lockups, capital calls, transfer restrictions, valuation uncertainty, and limited transparency. The portfolio manager must evaluate both the underlying asset and the vehicle structure. Now, let's connect alternatives to portfolio construction. Alternatives are often included because they may diversify traditional stock and bond risk. But diversification doesn't come from the word alternative. It comes from economic behavior. An alternative investment may help a portfolio when its return drivers are meaningfully different from the return drivers already present in the portfolio. Correlation matters, but correlation must be interpreted carefully. The portfolio framework on screen reminds us that risk depends not only on individual asset risk, but also on how assets move together. When an alternative has low or negative correlation with the existing portfolio, it may reduce overall volatility. But the benefit becomes weaker when the alternative has high volatility, high correlation, or hidden exposure to the same economic forces. A careful diversification analysis should ask several questions. Does the alternative have distinct economic risk drivers? Are the correlations measured from reliable data? Could reported correlations be distorted by stale pricing or appraisal smoothing? How does the investment behave during market stress? Does the allocation improve expected net performance after fees, taxes, liquidity costs, and governance costs? This is especially important for private assets. If valuations are updated slowly, reported returns may appear smoother than the true economic value. The asset may look less volatile than it really is. Risk is also broader than standard deviation. Investors should consider tail risk, drawdown risk, funding risk, redemption risk, concentration risk, counterparty risk, and operational risk. A good portfolio decision combines quantitative analysis with judgment. Let's finish with fees, transparency, valuation, liquidity risk, and due diligence. Alternatives often have higher and more complex fees than traditional public market funds. Fees matter because investors keep net returns, not gross returns. The fee framework on screen highlights a simple idea. Management fees, performance fees, hurdles, expenses, and other fund-level costs can materially change the investor's final result. Fee analysis should ask whether performance fees are charged only after a hurdle, whether there is a high water mark or loss carry forward, how expenses are allocated, and whether the expected net return justifies the complexity and illiquidity. Transparency is also critical. Public securities usually have observable market prices. Private assets may rely on appraisals, models, recent transactions, comparable companies, discounted cash flow analysis, or manager judgment. These methods may be reasonable, but they introduce uncertainty. Valuation matters because reported performance may be less precise than it appears. Risk measures may understate true economic volatility. Fees may also depend on values that aren't directly observable. Liquidity risk is the risk that the investor cannot sell, redeem, or borrow against an investment when needed, or can do so only at an unattractive price. Important liquidity terms include lockups, redemption windows, notice periods, gates, side pockets, capital calls, and distributions. A practical due diligence process should evaluate the investment thesis, manager process, team, incentives, risk controls, fees, valuation policy, liquidity terms, leverage, legal documents, tax issues, conflicts of interest, and the role in the total portfolio. So the final lesson is simple. Alternatives can be useful, but they require careful analysis. Don't buy the label. Understand the asset, the strategy, the vehicle, the manager, the fees, the valuation process, and the liquidity terms. Thank you for watching. I hope this lecture helped you understand alternative investments more clearly, and I'll see you in the next video.